I'm using AI like ChatGPT and Grok to assist me with my stock picking. This is a part of my public YouTube portfolio series where I pick a stock every week. For this video, I'm looking at stocks that have been the hottest trending topics on X.com. I've been leveraging the new Grok AI to get some insight. And a trend that I've been seeing a lot lately is health and wellness, but with focus on convenience. So I'm going to ChatGPT. I'm asking what are the top publicly traded companies that make health and wellness more convenient. And ChatGPT comes up with Teladoc and Hims and Hers, which are two that I wanted to look into. To narrow this down, the first step that I like to take is to look at the financial health of the companies. So first, I'm going to ask ChatGPT, give Hims a rating from 1 to 10 in terms of financial health, 1 being the worst and 10 being the best. Take into account liquidity, solvency, profitability, and operating efficiency. Please use stockanalysis.com for the latest quarterly reports. I found in the past that if I did not specify the source for the information for ChatGPT, that I would get some bad data. So since then, I've been requesting that ChatGPT use stock analysis, and I've had good results with that. I like to use these for figures: liquidity representing the short-term liabilities, how well a company can handle the short-term liabilities. Solvency looks at the long-term liabilities. Profitability, of course, is how profitable are they, and then how efficient are their operations. So ChatGPT comes up with a score of 7 out of 10, reflecting a strong position with potential for further profitability and efficiency improvements. In terms of safety, having a good current ratio and a good quick ratio are really important, as well as solvency, of course. So Hims is not in danger of going out of business. They can handle their liabilities. It's just a question of, are they able to increase their profitability and their operating efficiency? And based on this, I would say that they're a safe enough investment for me to take this analysis to the next step. Now, when I do the same thing for Teladoc gets a worse score. Teladoc getting 4 out of 10 from ChatGPT, indicating below average financial health with significant challenges in achieving profitability and operational efficiency. Based on this, I'm going to look further into Hims instead of Teladoc based off ChatGPT. And this is how I like to use AI. I like to use ChatGPT and Grok to speed up the process. I'm still going to do my due diligence and look at the free cash flow analysis for a company before I invest. However, AI just helps me narrow down that process. I don't have time to do an in-depth analysis into 10 different companies every week. So this is where AI comes into play. It just makes this process a lot faster. This is the spreadsheet that I like to use to do a free cash flow analysis. I like to analyze free cash flow because free cash flow is the sum of money that a company uses to return value. They may use their free cash flow to pay off debt, which lowers their interest payments. They may use it to try to grow the company, or they may use it for dividends. But no matter what they're using their free cash flow for, this is the sum of money that I want to analyze. I don't like to look at earnings as much because earnings can be negative, especially if they're able to show losses on paper. However, a lot of these losses are not actually reducing the cash that they have on hand to leverage with their company. That's why I like to use future free cash flow analysis. And this is the spreadsheet that I built to do that. It's nearly 100% automated. I type in the ticker here. So I'm analyzing Hims, and then all of this information is automatically pulled from the web, except for the analyst estimations for future revenue growth. This I do have to enter in manually. For some reason, I just have issues pulling this data automatically. I just pasted this table in. I have high analyst estimates, average, and low. See, there's a large difference between the analyst estimations here. For 2024, they're pretty much all in line with a little bit of variation, but then going forward into the future, 2025, there's a massive variation between analyst estimations. So this is going to go into my free cash flow analysis. Back to the dashboard. This is where I have 5 different estimations for the intrinsic value of Hims. If the high analysts are correct, then the intrinsic value would be $81 per share, which would be really good considering Hims is currently at $26.56 per share. If the high analysts are correct, then this is a really good buy. The average analyst estimation would put it at $39 per share. The low would put it at 15. My projection, which I'll talk more about in a second, puts it at 27. And then the past projection puts it at $89 per share. What this means is if Hims is able to continue increasing their revenue at the same rate as they have in the past 5 years, this is what their fair share price would look like today, according to my calculation. So their past revenue growth over the last 5 years has been 60% per year on average, which is insane revenue growth. The analysts do not think that kind of growth is going to continue, but if it does, that's what I'm looking at. So this is how I look at my estimation for the fair share price of Hims. Now let's look a little bit more into the assumptions that I'm making that bring me to these share price estimates. So first and foremost, let's look at the free cash flow margin. Free cash flow margin is the percent of revenue that is free cash flow. So in the past, they have had negative free cash flow. However, in the last year, they just got up into positive free cash flow margin of 6.5%. This is for 2023. 2024 is not over yet, the fiscal year 2024, but for the last 12 months, their free cash flow margin has been 13%. So looking at their trend in free cash flow margin, they have been trending towards profitability. Another thing to consider is that research and development does not get included into their free cash flow. And for a lot of companies, I will include research and development into their free cash flow, which would significantly increase the free cash flow margin in this case. Research and development is an expense that goes towards growing the company. Now, it's somewhat debatable. How much success does a company get from their research and development? That's up for debate, but some percentage of this I think would be fair to add to the free cash flow. So hypothetically, the free cash flow margin of 6.5% for the year of 2023, if we were to give Hims credit for half of their research and development budget, which would be about $25 million. That would increase their free cash flow to $80 million, which would increase their free cash flow margin to about 10%. To me, it looks like they're trending towards a free cash flow margin of greater than 10%. Factoring that into my equation here, I'm going to make the assumption that their free cash flow going forward is 10%. I think it will probably be greater for the next 5 years, but I'm going to stick with just a 10% growth in free cash flow margin. So if that is the case, these estimates are in play. If they have a annualized revenue growth going forward of 25%, then their fair share price is $27 per share. This is what I'm looking to beat. If this company can do better, then 25% revenue growth over the next 5 years, and they can achieve 10% free cash flow margin, then their current share price is justified. In my mind, this is a conservative estimate, given that this spreadsheet only calculates 5 years of growth and then assumes a constant growth rate of inflation. So every company is going to go through an initial growth period, and then when they hit maturity, their growth will level out. For this spreadsheet, I'm assuming 5 years of growth, and then a constant growth rate after that. That's my perpetual growth rate of 3%, which I set equal to inflation. I'm also assuming a discount rate of 8.16%. This is the amount of perceived risk that I have investing in this company. This number I generally will Google. I will usually use the cost of equity, which in this case on Alpha Spread is 8.16%. So with these assumptions in play, I'm looking at an average fair share price of $39 per share, and a low share price of $15 per share, a high target of 81. Given that the current share price is $26 per share, that would put my worst case scenario at about a 40% loss and my best case scenario at a 3 times gain or a 200% gain. For me, this is an acceptable risk to benefit ratio. So I will be investing $100 this week into Hims at the share price of about $26.50. If you want to see last week's video, where I invested $100 using AI to assist me in my stock picking, you can check that out right here. And until next time, cheers.